California's housing market just hit a 21-year low. In November 2025, only 23,317 homes were sold across the entire state. That's 30% below normal. But here's what makes this shocking. Mortgage rates have been falling. They dropped to 6.3% and kept going down into 2026. Lower rates should mean more buyers. That's not happening. The median home price in California is $735,000. Compare that to the national median of $419,300. California homes cost 75% more than the rest of America. Think about that for a moment. 3/4 more expensive. This creates an impossible situation. Buyers can't afford to get in. Sellers can't get the growth they expected. The market isn't frozen. It's broken. This isn't a temporary dip or a normal correction. Something deeper is wrong. How did one of America's largest states create a housing market where almost no one can win? The answer isn't what most people think. It's not just about high prices or tough economic times. There's a structural problem at the core of California's housing crisis, and it's been building for years. This is HouseLine USA, and if you want to stay informed about real estate trends that actually matter, hit that subscribe button right now. Let's break down what's really happening. Number 1, the structural mismatch. Here's what's really driving this crisis. California has a structural mismatch between supply and demand. That's the expert term. But let's break down what it actually means. Hannah Jones is a senior economic research analyst at Realtor.com. She's been tracking California's housing market closely. According to her research, the state has pushed prices far beyond what most workers can afford. But it's not just about high prices. It's about why those prices exist in the first place. California isn't building enough homes. More specifically, it's not building enough affordable homes. New housing construction can't keep pace with population growth. This has been going on for years. The gap keeps getting wider. Why aren't more homes being built? 3 main reasons. First, construction costs in California are extremely high. Second, the permitting process takes forever. Third, regulatory hurdles block development at every turn. These aren't small obstacles. They're massive barriers that slow down housing construction across the entire state. Think about what this means. Every year, more people need homes. Every year, fewer homes get built to meet that need. The math doesn't work. It can't work. This isn't a problem that fixes itself over time. It gets worse. This is why Hannah Jones calls it structural. The problem is baked into how California operates. It's not about the economy having a bad year. It's not about interest rates being too high. The system itself prevents enough homes from being built, especially the kind of homes that middle-income workers can actually afford. When you can't build enough supply to meet demand, prices stay high. They stay high even when other market conditions improve, even when mortgage rates drop, even when buyers desperately want to purchase homes. The foundation of the market is broken. Everything else is just a consequence of that core issue, and those consequences are severe. Number 2, the sales collapse. Let's start with the most obvious one. Home sales in California have collapsed. November 2025 saw just 23,317 homes sold. That's an 8% drop compared to the same month the year before. But it's even worse when you look at historical averages. Sales were 30% below what California normally sees. This isn't a small dip, it's a dramatic decline. Here's where it gets really interesting. Mortgage rates were falling during this time. The 3 months ending in November 2025 saw rates average 6.3%. That's lower than earlier in the year. And rates kept dropping into 2026. Normally, this would spark a buying rush. When borrowing gets cheaper, more people can afford monthly payments. More people jump into the market. That's not what happened in California. Lower rates did almost nothing. Sales kept falling. Buyers stayed on the sidelines. This tells us something important. Price isn't just high. It's so high that even cheaper borrowing can't bridge the gap. When a 6.3% mortgage rate can't help, you know affordability is broken at a fundamental level. Think about traditional market corrections. Usually, when prices get too high, one of 2 things happens. Either prices drop until buyers return, or rates fall enough to make those prices affordable. California is experiencing neither. Prices remain near record highs. Rates have fallen. Yet sales hit a 21-year low. This is what happens when the structural problems we just discussed take hold. You can't fix a supply shortage with lower interest rates. You can't solve a construction crisis with cheaper borrowing. The tools that normally balance real estate markets simply don't work anymore. But it gets worse. Buyers aren't just staying away. They're actively walking away from deals they've already made. Number 3. The cancellation crisis. But it gets worse. Buyers aren't just staying away, they're actively walking away from deals they've already made. December 2025 set a troubling record. Nationwide, 16.3% of all home sales that went under contract got canceled. That's the highest cancellation rate ever recorded. 1 in 6 deals fell through. Buyers signed contracts, made offers, and then backed out. That's a massive number. California's metros did even worse. Sacramento hit 19.9% cancellations. Nearly 1 in 5 deals died. Riverside reached 19.2%. These aren't just above the national average. They're significantly higher, and they're happening in major population centers. Redfin tracked the annual increases in cancellations across the country. San Jose saw the nation's largest jump. Oakland came in second. Sacramento took third place. 3 California cities are leading the country in people backing out of home purchases. The Bay Area got hit especially hard. What does this tell us? Buyers are trying. They're making offers. They're going under contract. But somewhere between signing and closing, reality sets in. The inspection may reveal issues they can't afford to fix. Maybe they realize the monthly payment is unsustainable. They may get cold feet looking at the final numbers. This is buyer hesitancy in its clearest form. These aren't people who never entered the market. These are people who got close enough to almost buy. Then they walked away. That takes serious doubt. That takes real fear about affordability. Contract cancellations reveal something surveys can't. When someone cancels a deal, they're usually losing their deposit. They're backing out despite financial consequences. That means the fear of buying is stronger than the fear of losing money. The commitment to a California home at current prices feels riskier than forfeiting thousands of dollars. This level of hesitancy doesn't come from normal market anxiety. It comes from a fundamental lack of confidence. Number 4, the inventory mismatch. Now here's something that doesn't make sense at first. California actually has more homes for sale than it did a year ago. Active listings hit 56,000 in December 2025, an 11% increase year over year. Normally, more inventory should lead to more sales. Supply rises, demand follows. Right? Wrong. Sales fell 8% over the same period. More homes are available, yet fewer are selling. That's the opposite of how housing markets usually behave. But there's more to the story. Those 56,000 listings might sound like a lot. They're not. Before the pandemic, California regularly saw 70,000 to 90,000 active listings during peak seasons. The current number is still far below normal. The market hasn't recovered to healthy inventory levels. July 2025 showed a brief moment of hope. Listings peaked at nearly 78,000 that month. It was the first time California exceeded 70,000 listings since 2019. 6 years since the market has seen that much available inventory. But even that peak wasn't enough. It was still below the typical range California used to maintain. So inventory improved from the absolute lows of 2020 through 2022. Those were historically tight years. Almost nothing was available. The recovery from that extreme shortage has been slow, and it's incomplete. The market still operates below normal capacity. Here's the real problem. Even with more homes listed, they're not moving. Sellers are putting properties on the market. They're sitting there. Homes are stuck in what experts call extended listing limbo. They're available but not selling. Days on market keep climbing. This creates frustration on both sides. Sellers wonder why their homes won't sell despite strong pricing. Buyers see inventory but still can't afford to buy. The disconnect is massive. Number 5, the price reality. Let's talk about those prices. California's median home price in November 2025 was $735,000. Remember that national median we mentioned earlier? It's $419,300. California homes cost $315,700 more than the typical American home. That's not a small premium. That's an entirely different market. Here's what makes this even more striking. The California market has supposedly been cooling. Prices did drop slightly from their peak. In June 2025, the median hit $751,000. By November, it fell to $735,000. That's only a 2% decline. The market is barely off its all-time high. Sellers aren't exactly celebrating either. Over the past 3 years, home prices only rose 9%. That might sound good to buyers, but for sellers, it's disappointing. Real estate is supposed to be an investment. 9% growth over 3 years is modest. After accounting for inflation and holding costs, many sellers are barely breaking even. So we've got a lose-lose situation. Sellers see weak appreciation and extended listing times. Their homes aren't growing in value the way they expected. Meanwhile, buyers face what experts call insurmountable barriers. Even with that modest growth, prices remain out of reach. Cities like Los Angeles and San Jose are hit hardest. Typical buyers in these areas need to devote huge portions of their income to mortgage payments. We're talking disproportionate shares compared to other states. Middle-income workers simply can't make the math work. And the luxury market? It's booming. December 2025 had approximately 17,000 active million-dollar listings statewide. That's 9% higher than the previous year. The high end keeps climbing. Meanwhile, affordable options disappear. The price distribution has permanently shifted upward. California is becoming a state of extremes. Number 6. Who gets hurt? Let's be clear about who's paying the price for this crisis. It's not the wealthy. It's not the people buying those million-dollar homes. It's the middle-income workers. The people who keep cities running. Teachers, nurses, firefighters, retail managers, skilled tradespeople. The backbone of California's economy. These workers earn decent salaries. In most states, they'd be homeowners. In California, they're priced out completely. Median-earning households spend far more of their income on housing compared to other states. The gap isn't small, it's enormous. Take Los Angeles and San Jose as examples. These cities require buyers to hand over massive chunks of their paychecks for mortgage payments. The math simply doesn't work for someone earning the median income. You can't spend 50% or 60% of your income on housing and still afford everything else. Food, transportation, healthcare, and childcare. The numbers don't add up. Homeownership isn't just out of reach. It's completely impossible for many. This isn't about delaying a purchase for a few years. This isn't about saving a bigger down payment. For middle-income workers in California's major cities, buying a home has moved from difficult to unrealistic. Think about what this means long-term. The people who teach your kids can't afford to live near the schools. The nurses at local hospitals are commuting hours each way. Police officers and firefighters live in neighboring counties or states. Essential workers are being pushed further and further out. Both buyers and sellers are trapped in this dysfunctional market. Buyers can't afford entry despite having stable jobs and decent incomes. Sellers can't see meaningful appreciation even after holding properties for years. The market has normalized from its extreme tightness during the pandemic. But it hasn't returned to balance. It's stuck in a broken middle ground. Nobody wins here. The system itself is failing. Number 7, the exodus reality. So what are people doing? They're leaving. California residents are seeking more affordable markets elsewhere. This isn't just a few people making lifestyle changes. It's a steady flow of workers and families who can't make California work financially. The data shows this clearly. When sales hit a 21-year low, it's not because people don't want homes. It's because they can't afford them where they are. So they're looking at other states. Places where $735,000 isn't the starting point. Places where middle income actually means you can buy a middle-class home. This creates a real problem for California's future. When essential workers leave, who replaces them? How do you staff hospitals, schools, and fire departments when those workers can't afford to live nearby? Companies are noticing this, too. Recruiting becomes harder when housing costs make job offers less attractive. California has become one of the least affordable states in the nation. That's not opinion. That's a measured fact. Housing costs consume a larger share of income here than almost anywhere else in America. For median-earning households, the burden is crushing. Think about the ripple effects. Young families leave to find affordable housing. They take their spending power with them. Their kids leave the California school system. They stop shopping at local businesses. They're not paying California state taxes anymore. The economic impact goes far beyond real estate. This is the human cost of structural dysfunction. Policies and regulations that seemed small individually have added up over the decades. High construction costs weren't addressed. Permitting delays weren't fixed. Regulatory hurdles kept piling up. Nobody dealt with the core issues. Now the consequences are unavoidable. People vote with their feet. And right now, they're voting to leave California behind. Not because they want to, because they have to. The question is whether anything can change. Let's recap what we've covered. California home sales hit a 21-year low in November 2025. This isn't because of high interest rates. Rates have been falling. This isn't because of a lack of inventory. Listings are up 11% from the previous year. The problem runs much deeper. At the core is a structural mismatch between supply and demand. High construction costs, lengthy permitting processes, and regulatory hurdles prevent enough homes from being built, especially affordable homes. New construction can't keep pace with population growth. This gap has been widening for years. The results are clear. A median home price of $735,000 leaves middle-income workers completely priced out. Buyers can't afford to enter the market. Sellers see minimal appreciation despite holding properties for years. Record numbers of contracts get canceled as buyers back out of deals. Homes sit in listing limbo, available but not selling. Both sides lose in this broken system. And the market shows no signs of self-correcting. Here's the uncomfortable truth. Without addressing the root causes, this crisis can't be solved. Sometimes, markets don't correct themselves. Sometimes, they just break. California's housing market might be showing us exactly what that looks like. If you found this analysis valuable, hit that subscribe button and turn on notifications. We're tracking housing markets across the country, bringing you the data and insights that matter. Drop a comment below. Do you think California can fix this crisis? Or is the damage already done? Thanks for watching HouseLine USA. We'll see you in the next one.